one of the biggest fallacies, and one of the things I see a lot, new CFOs come in, for example, first thing they say is, I got to build a team. And they start hiring people, controller and FP&A, and those people come in and they start building a team, and they fail to appreciate, one, the level of commitment. Two, some of those people are not going to work out. And while they don't work out, that there's a lot of waste. And three, you probably need portions of all of their service and all of their skills, but you may not need the full thing. And in fact, you're unlikely to, especially for small business. We see this on the FP&A side. One FP&A guy is seldom going to have the full range of skills that make a very strong FP&A person. The data system, knowledge and that kind of stuff. But companies are so reluctant to take advantage of the fractional services and the shared services that are out there, and I think it's a real mistake. I mean, if you've got a structure, if you structure well, you can go a long way and get a lot more service in a way than you're going to get from an individual employee.
We're back with another Finance Fireside Chat by FutureView Systems, and for today's episode, I'm joined by two distinguished finance and accounting minds. We have John Baule here, the CEO of FutureView Systems, and Rocky Lalvani, Profit First professional. Rocky, why don't we start with you? Could you tell the audience a little bit about your background and yourself?
I come from a background of being a spreadsheet geek. I've been playing with spreadsheets since the days of the Apple II computer and VisiCalc, and I just didn't realize how powerful they were. And back then, when I wanted to build a business, there was no internet, there was no anything else. So it was like, how do you build a business telling people I've got these spreadsheets that I can help them with when business owners don't even know what spreadsheets are? And then later on, I got this aha. I didn't realize that business owners weren't looking at their financials. I assumed if you're a business owner, you understand the business of business. Turns out for most small businesses, they've got no idea what's going on financially because they're focused on what they love. And what they love is doing whatever it is that they built their business for. And the accounting seat is usually not top of mind for them. And so here you are trying to run a large business and you don't have clarity on what's going on, then how do you make wise decisions? So I kind of brought those two skills together to take the numbers from an accounting perspective and turn them into a perspective that a business owner goes, oh, that's clear. I know how to do and what to do with that data and how to take action moving forward.
I love it already because it very much dovetails with what we do at FutureView. And I'll say that for us, we tend to, I've often said this, nobody ever starts a business. Like you said, they start businesses because they love doing something. Nobody ever starts a business and says, you know what I really want to do here is create a killer finance function. Never happens. And so what happens is, you get these founders who start a business and they're moving along and they're always like, finance is sort of, okay, I know I need some kind of system now because my cigar box with the cash is no longer working, and then I keep adding little bits, but my finance function is always dragging behind the rest of the business. And at some point, if the business keeps growing, which you hope it will, it hits that inflection point where everything starts to fall apart. And the fact that you don't have that structure, brings your business to a halt. It stops growth. And I've seen that happen where all of a sudden, you heard the famous stories about the people like grabbing the box and writing the shipping address in crayon because the ERP is not printing out the invoices. So I think that what we do is we help companies erase that debt, it's kind of like technical debt, but on the finance side, erase that functional debt, and then start to operate with sort of a tried and true process for finance and things that you can do, whether you're a big company, and create a kind of a scalable process, which goes hand in hand with what you just said, because you're right. I'm always shocked at how many people think they want all this financial data, and you give them a lot of financial data and then they never look at it, or it's in the rearview mirror by the time they, it's not even meaningful by the time they get there.
And that's why I love the name of your company, FutureView, because when you think about it, most accountants, I say, are rear view. Yeah. They're telling you what happened 60 days ago. And the average business owner is, okay, thanks for that information, but it's irrelevant. I need what am I going to do for the next 60 days?
Yeah.
And so having the future view of, hey, what do we need to do today to be where we want tomorrow? And having clear targets and knowing how you can go from where you are to where the target is, I think is super powerful. But that's not the way that the finance industry traditionally speaks to business owners.
I think you're right. I think it goes right along with that idea of the progression, because you always sort of start with the bookkeeping and the controller, and if you think about, having been a CFO for a long time, half the battle is marrying the two parts of your business, where I think one is sort of the controller function, everything up to the present, looking backwards, and then that future piece, that FP&A piece, everything from the present looking forward. And you go to a controller and you say, tell me what my revenue is, and they can get you down to, the penny. This is revenue. But then you say, hey, what would my revenue be if I added 3 salespeople every quarter and they hit 50% of quota in the first year and 75% in the second year? And what's that look like? And their head explodes, because it's just not the way. That's ambiguity and imprecision that they don't love to deal with. So, and that's why you probably see this all the time, but I get a lot of CEOs who, when they call in a CFO, they say, you know what, I'm sitting in my management meeting and my FP&A person is telling me that bookings are going through the roof, and my controller is telling me that revenue is dropping each and every month. And I'm like, I have no idea how to put these two together. It's like kind of like two different perspectives. So,
well, and I think the reason that occurs is, if you think about it, what you're talking about in the world of accounting is 3 different reports, kind of, and I've never seen someone merge them well and then use it for prediction well. And that's basically what we do by using Excel sheets, and we figure it out. But you can do that. And this is also, I think, why the founder's struggling. He's like, sales are through the roof. Yeah, but your accounts receivable is also through the roof, because they don't pay maybe for 30, 60, 90 days.
Yep.
And you've got to carry that cash flow in the meantime. And that's not showing up on the P&L, right? It says you booked a sale, but the cash didn't come in. And then you're like, oh, where'd it go? This doesn't make sense.
Wait a minute. You're saying you can be profitable and run out of cash at the same time, huh?
I say that one of the top reasons for business failure and cash flow problems is growth. They grow faster than their cash, and they never planned how much cash they need for that growth. So going back to your example, if you're going to hire those 3 salespeople, you're going to start paying them, right?
Right.
But yet they're not producing yet. And it might be a while till they're producing. Even if they do hit a sales goal 6 months out, if you've got 90 days between when the sale is made and the delivery and the payment, you got to cover 9 months of a sales rep salary. You need to know that and say, can I do that? And how am I going to do that?
Absolutely. Yeah, no, you're exactly right. That has a big impact. Hey, Matt, go ahead. I didn't mean to preempt the question, but I'm kind of curious. Talk about, you've got kind of a very catchy title with the way you've shifted around the basic equations in finance. I'd love to hear a little more about how to think about that.
So that all comes out of the book Profit First by Mike Michalowicz. He's a serial entrepreneur. He actually owned a company that did forensic data. So they investigated Enron. Enron was guilty, by the way. You can play all kinds of games with your P&L and your balance sheet. If you want to, I can make them say whatever you want, but that's not equal to cash in the bank. He sells the company. The company was okay. It was never as profitable as it could be. He walked away with a payday. So for him at that moment, profit was not a habit. Profit was an event. It occurred when I sold the company. He takes all this money, thinks he's the smartest businessman in the world, goes out and starts investing and doing all this crazy stuff. And the next thing you know, he's out of money and he hits bankruptcy. And so that really got him to thinking, how did we get this so wrong? And how did I screw up? And one of the things he realized is he's like, I was given the wrong equation by my accountant. We're all told sales minus expenses equals profit. So for most people, right, if you look at the P&L, the profit's at the bottom. It's
Right.
the leftover. And that's the problem. It makes profit not the driver, but the result. And he said, let's change this around. If we go into business to be profitable, why isn't it sales minus profit equals expenses? And now your expenses are constrained, because too often in business, we say, oh, we got to spend money to make money. And I challenge that.
Yeah.
I think there are ways to do it much wiser. So if you're going to take your profit first and you don't spend it, and then you learn, hey, this is how much I need to run my business on. I've got an expense cap. How am I going to allocate those dollars appropriately to get the best results? And that's all it is.
Just changing the perspective, the way to think about, yeah, I'm going to have this much at the end. Yeah, I like it. I think you need to take that theory to our government.
Yeah, good luck.
No, it's an interesting point you make, Rocky, where we talk about, in this accounting equation where profit is last. Let's talk about cash flow, right? Because your cash flow statement, your net income is first. And so that kind of brings us to this culmination of focusing on cash. And everybody talks about cash being king, and everybody thinks that they have a pulse on it. But as you kind of alluded to, there's this nuanced approach where just because you're profitable doesn't mean that you have the cash to cover your ongoing expenses. Would love to kind of get your take on how that ties into your approach when maybe setting expenses, right? And maybe doing budgeting, because you're now taking the profit and the sales to get to your expenses. So now that I have my expenses, we sort of roll that up into a budget at some point, I'm assuming, right?
We do. What this actually is, Profit First is not an accounting system. It's not a finance system. What it truly is a cash flow management system. And many of you might be familiar in the old days with what they talk about with envelope banking for your cash. Back in the old days, people would get cash, they'd get paid, they'd have envelopes. Every envelope had a purpose: rent, groceries, whatever. And you put your money in the envelope. When the envelope ran out, you stopped spending and you got creative until more money came into the envelope. This is the exact same system for a business, except instead of using envelopes and keeping cash, we use bank accounts. So the money comes into the business up front. You know how much revenue came in. It's clear as day. It doesn't matter when it was sold, anything. All you know is in this bank account, since the last time we did anything, this much cash came in. Now, if you're doing this on a regular rhythm, you're used to a certain amount of cash coming into your business, let's say every 2 weeks.
Right.
And so every 2 weeks I go, I'm expecting $500,000 in that account. Did $500,000 come in? Yes or no? If it's no, it's like, oh, wait, well, let me go find out what's holding it up. 3 big invoices didn't get paid. I need to make phone calls. Once the cash comes in, the first thing we do is we take our profit. So if you've got a 20% profit margin, we take 20% of that $500,000 and we put it in the profit account. Then we take another chunk, and see, this really depends on the type of business. If you're a small business and you're the sole kind of owner and you're taking your paycheck from the business, we actually put money aside for the business owner to pay themselves, because most business owners pay themselves last. It's kind of an afterthought. They're the first one to not get paid.
Yep.
And so we try and tell them, put your money aside. Then we set up an account for taxes, because at some point the company or the owner's got to stroke taxes. So why not put that money aside so it's ready? And now we have our operating expenses. And now I need to live on that much cash. And so if I know this 2 weeks that a lot of money didn't come into my operating account in cash, I'm going to have to figure out how I'm going to get through the next 2 weeks, or figure out how to bring in more revenue. So it's much more visceral, feeling driven, and it's real time. It doesn't matter that nothing happened. It's all real time cash.
When you talk about the cash account, are you actually physically creating bank accounts for that profit piece? So you really put it into a banking. Interesting.
Yeah.
I made the kind of joke about government, but it's not in some ways it's got some similarities in terms of the way they set up funds for all the different proceeds that come in and have to manage within that. So it's that same kind of idea in a way.
Exactly. So you're giving every dollar a purpose. You're sending it to do its purpose. Now, sometimes we'll even go into far more detail. So let's just say cash comes in. If this is cash that we know is for something that's going to be delivered in 6 months, and we've got essentially money up front, we're going to put that aside. We're not going to bring that into our regular operations because technically we haven't earned it.
Yeah.
If you've got a business with a high cost of goods that you have to pre-order, let's say we've got to bring in containers from China or somewhere, we'll actually take a percentage every time we sell something and we'll put it aside so that the next time you need to pay for a container, your money's there. So we take these systems and we adapt them to the business and how their cash flows and what's most important to that business. And then you kind of let it be. And some businesses are kind of roller coaster. So, in the world of retail, all your money might come in October through December because of Christmas season.
Right.
Well, if we got a business like that, what we do is we take the excess that comes in, we set it aside, and then every month for the remaining 9 months, we dole it out month by month so that you learn to have smooth cash flow. Really, what this is about is doing our best to smooth out your cash flow over time so that you aren't going through the ups and downs so much.
Makes a lot of sense. How does it we do our FutureView platform is set up for P&L forecasting, budgeting forecast, cash flow forecasting and balance sheet forecasting. How does your system kind of interface with if people are doing that? Well, because it should kind of dovetail, right?
They should. And so they should all match up.
Mm-hmm.
But the first alarm bell is going to be the bank account.
Right.
And it's going to give you that immediate response. And if the owner or the CFO, let's say in that particular business, depending on the size of the business, we tell people not to do this more than once a week. So if they're doing this once a week, like Monday morning, they come in and they allocate all of the cash from last week. Every Monday morning, you know how last week went immediately. You don't need to pull up reports. You don't need to do anything. You know what happened on a cash basis.
Right.
You can look at your other reports and you can start to forecast and say, okay, the report says I need this much cash. If our allocations are coming, we know we're going to be able to cover it. And so it's putting the two together. Your reports are telling me what's going to happen. This is telling you what happened immediately. We're not waiting 60 days for accounting to get back to us.
It's almost like instead of having to look at a balance sheet that I'm waiting till the end of the month to get produced, I look at my bank balances and I can see exactly what's in the different pieces. I get it. Yeah, it makes sense.
And as you see the profit account build up, you now have a reserve. Mm-hmm. Every business should have reserves. You can still build up 6 months of reserves that way. If you are doing better than what you projected, the accounts automatically build up excess cash. If you start to go up and grow, you're not wasting the growth. Like, it doesn't disappear. It still gets set aside from that standpoint. And let's just say you do end up being short. You're going to know, hey, there's shortage in the cash account right now. Something's going on either with our expenses or with our revenue. Now we have to sit down and have a meeting of what are we going to do about it and how are we going to handle it. But the cash is there, so you can sleep at night.
Got it. What size companies do you tend to work with, Rocky? What kind of companies does this method fit the best?
I tend to work with 7-figure into 8-figure business owners. But here's the reality. You start getting up into the 8 figures, this is called treasury management, right? That's all it is. And they make it this fancy thing instead of, hey, you know what? The simplest way to do treasury management is a handful of bank accounts, and at that point, then you can start to say, oh, what should we do to get interest on the accounts or those types of things? And that's more that way. But I don't think it matters what size your business is. This gives you immediate ideas of where your cash is and how it's flowing.
How many, like, let's take, you got a $10 million business.
Hmm?
How many bank accounts would that entail?
If they're a basic business, 5.
Okay.
If they are a little bit more sophisticated or they have some special needs, we might go up to 7 or 8 or 9. And those things would be like saving for large cash purchase orders that they have to do. It might be because they put money aside so that because they have bumpy revenue, they want to smooth out revenue. It could be that they're getting large deposits and they want to hold their deposits until it's closer to when the money is actually being spent. So again, it's up to them, but the core is generally the 5 accounts. And again, if owner's pay is running through payroll and you've got good cash flow, you could probably drop that particular account and go down to 4. Again, I tell people adapt it to the way you do business.
The key is that someone's looking, I think it's a behavioral thing, really. I mean, because
It is.
Notionally, I mean, if I'm keeping track of my cash and I'm keeping track of my financials on a regular basis and looking at the balances, I'm doing kind of a similar exercise. The difference is you're literally looking at the bank balance. You are kind of taking it back to the old cigar box. How much cash do I have in that cigar box at the end of the day? Yeah, I get it.
I don't know about you, but when I sit down in front of the TV, if I have a bag of chips, there's a good chance it's going. Right? But think about this. If you sit down in front of the TV and the bag of chips is 2 ounces versus 10 ounces, you'll do your 2 ounces and you'll stop and you go, okay, I'm done. And
You'd put
really,
Costco out of business too.
well, no, because you get 100 of their little bags, and then you take one every day instead of
the one 300-ounce bag that you
Still
save
one-
$3 on. Yeah.
My wife literally will, buy a bag of chips, and that bag of chips will last like a week and a half. I barely make it home from the store. It doesn't matter. You're exactly right. So,
this is really emotional behavioral constraint systems. And they tell you the same thing. If you want to go on a diet, the first thing they tell you is get a smaller plate, right?
Yeah.
So all we're doing is we're forcing business owners to stay constrained. And part of the problem is, especially for fast growing companies, especially if they've got venture capital behind them, they're like, spend, spend, spend. It's like, no.
Yeah. So
like constrain and make profit. That's why we're in business.
I'd like to pivot, if I could, us to some of the topics revolving around business models, right? And the idea is not all revenue and sales is created equal. There's something to be said of value, a value-added component to like a recurring revenue business model. John, would love to hear kind of your take on the importance of forecasting that cash flow and what that brings insight into for the business owner and the team at large.
Yeah, I was actually going to be really curious, Rocky, to hear your thoughts on that. But like, we work with a lot of SaaS businesses, right? And the SaaS model is you invest to sell, and sometimes if you're lucky, you get them to pay up front, which is the ideal. But if you don't, you're putting a lot of your selling dollars into getting that upfront contract with the idea that there'll be a long tail of ongoing revenue from there. So the whole forecasting, I mean, I think it's a really powerful model as long as but instead of managing necessarily the cash piece, though you do have to watch the cash, you also have to very carefully manage the churn and the lifetime value of those customers and the lifetime value associated with it relative to the customer acquisition costs, and manage that. Because I've seen companies where they didn't appreciate the churn and therefore didn't properly estimate their lifetime value. And they're doing exactly like you said. They've got money they're spending to drive growth, not realizing that they're spending more than the lifetime value the customers are adding. And so getting those metrics clear is a really important piece. So
you've got to have more people coming in the top of the bucket than dollars going
Yeah.
out of the bottom of the bucket. So I think on a monthly basis, you should all, and honestly, depending on the particular business and how volatile, maybe even more frequency, but how many new clients, and then how many clients left? What is
Yeah.
the average duration of your clients? What's the average duration of your clients who've left? What's their average monthly value? We take all of those things and we just put them into what we call our math equation for a business. So our math equation in simplicity is we start with some sort of lead flow number.
Mhm.
We look at closing rate. We look at then average transaction value, and then customers repeat purchases, and then that we can just model out revenue. Like literally I can model out revenue in 5 minutes just by knowing the basics. Now each of those numbers might have 30 inputs, and you need a system like yours to be able to bring it all together, but it's not hard to do it when you just understand the basic formula. Then you can start to figure out, hey, how do we change it? Do we upsell some of our people from, if they're paying $100 a month to $150? Is there a way to get them to buy more often? Is there a way to make sure that they're sticking? So how do we make it so it's hard to switch off of our platforms? Not trying to do anything illegal, but meaning that our platforms are so good and so ingrained that people don't want to go somewhere else.
Right.
And building all of those things out, and then creating value pricing. Too often we're doing it based on our inputs instead of the value the client receives.
Right. Good point.
In order to get to this profit-taking moment, you have to get to profitability, right? And that's problem number one, that, chicken and egg, that we have to get through first, right? So we'd love to hear kind of your thoughts, John and Rocky, on how you best manage your expenses in a way where you're understanding what you're budgeting for, such that you can get to the profit number you want. Because at the end of the day, while some of that profit is something you want to take out, the more profitable that you can make your business, the greater the potential market value is for whatever that next step is in the evolution of the business.
So I bet I'm going to agree with Rocky on this. I personally am not a big. There are businesses that lose a ton of money for a long time, and sometimes I guess there's a certain investment that makes sense, but you lose a lot of optionality when you're constantly depending on that next round of funding that you have to raise, and you never know what's going to happen to the market. I remember being a channel advisor, and we were losing money after we went public, and we were asked many times, why aren't you losing more money and generating more growth? And all of a sudden the market changed a little bit, and it was like, when are you going to be profitable? And I'm like, okay, you can't just switch philosophies on a dime that easily. And so I think that I personally like a company that maintains profitability or has a substantial amount of funding locked up that they can count on to do something. Like obviously, if I'm going to launch, rocket ships, I got to have enough. I got to invest a lot of capital up front on that. But at least I want to know that I've got a clear line of capital to spend on that. So.
I've never understood that philosophy. And this is what I talk about with unintended consequences. When you start telling a company to spend money to grow clients, if they don't know what money is actually driving client growth, they literally waste so much money in marketing, and they'll throw more money at it without thought, because that's what you told them to do. And that doesn't make sense to me. I know it's the mantra out there. I don't believe in it. We try to do is have our costs follow our growth. So instead of hiring somebody in anticipation of growth, I want to have growth and then we hire people. So we might squeeze the business a little bit going through these growth cycles because it's more of a stair step.
How do you deal with it though if the business needs that person to grow in the first place? If that person is going to drive growth and you don't hire them first, then how are you going to get the growth?
So every business is unique. I think in the beginning we can go with variable workforces. So you can do you can outsource it, or you can outsource parts of it. Um, you can use contract workers instead of hiring people. Um, and the good news is if you're using contract workers, it's also a way for you to test them out.
Sure.
Because employees are the number one issue, and we tend to hire fast and fire slow. And it's one of the biggest areas we waste money in after marketing is the unproductive employee that wasn't the right fit. So there are ways to be flexible. You hire part-time or you got to figure it out for your business, but there's a variety of ways to do this.
I couldn't agree with you more on that. I think one of the biggest fallacies and one of the things I see a lot, new CFOs come in, for example, first thing they say is, I got to build a team. And they start hiring people, controller and FP&A, and those people come in and they start building a team, and they fail to appreciate, one, the level of commitment. Two, some of those people are not going to work out. And while they don't work out, there's a lot of waste. And three, you probably need portions of all of their service and all of their skills, but you may not need the full thing. And in fact, you're unlikely to, especially for small business. We see this on the FP&A side. One FP&A guy is seldom going to have the full range of skills that make a very strong FP&A person. The data system, knowledge and that kind of stuff. But companies are so reluctant to take advantage of the fractional services and the shared services that are out there, and I think it's a real mistake. I mean, if you've got a structure, if you structure well, you can go a long way and get a lot more service in a way than you're going to get from an individual employee.
And that's very true. And I think in today's world, I mean, we do fractional CFO. There are other companies that are bigger than me that will bring in an entire fractional accounting department.
Yeah.
And that's fine. Like you said, I think it's a much better value prop for a lot of people. And even there's fractional sales, there's fractional marketing, there's fractional IT. Every single part of this has become fractional. And the good thing about fractional is you can make decisions like that. You can cut losses quickly, or if it's not a good fit, you can make quick changes, but you're getting a higher talent at a lower cost, because a good CFO costs a lot of money, but a good fractional CFO for that particular business owner is a fraction of that. And for most of them, you get a CFO there that often in a smaller company, I don't know what they're doing all day other than causing problems.
What happens is you bring in a CFO in a small company, and maybe they're not many people, it's just them or maybe a couple of people. What happens is they're working the whole stack. So there's 10% of the time where they're doing exactly the type of things that you need to pay a CFO for. And 90% of the time they're doing the kind of things that you should be paying a bookkeeper or a low-level analyst for. So I think your point is right. Why not just buy the cream? Plus, you're not going to get, if you're a smaller company, you're not going to get the kind of talent sometimes that you just can't afford it. But you could afford a fraction, and you can get all the best ideas. So I think that's it. I'll just say one thing. I know you've probably heard the famous story about, I was thinking about it, of Picasso, where Picasso's drawing on the napkin, right? And he's at the cafe, and someone sees him drawing on the napkin, and they come over and they say, "Can I have that napkin?" He says, "Yeah, it's $30,000. And the guy says, "Hey, you just did it in 5 minutes." And he goes, 5 minutes to do it, put it on the napkin, but a lifetime to put all the skills together to get it there. And I think it's the same thing. You don't appreciate that when you hire a fractional person, you're getting sort of a culmination of a lot of experience.
I think if I would say under 20 million in revenue, fractional hands down. When you get over 20 million, then you can start to bring in actual people.
Yeah. I'm with you on that. I think especially now, as you start to see the whole AI thing taking shape and everything, I think we're going to start to see, companies with a few people and everything else is sort of either outsourced or automated. I think you can do create quite a company with very few resources.
And I know everyone's talking about AI in the finance industry. I still haven't figured out how it's going to be able to discern and really do some of the soft parts of what finance is all about.
Yeah.
We'll see.
I think you're right. I mean, I think there's definitely a place for it, but I've been around, I go back to powdered wigs and quill pens. And I think that if you look at the waves you've had, I remember when they used to say the spreadsheet would wipe out everybody in all the jobs, and it didn't. And then they started to pull everything together into platforms and ERPs, and they didn't wipe out all the jobs. In fact, they created more. And now we've got the internet and everything's cloud-based. In theory, if I could take all those spreadsheets and put it into a cloud application, I shouldn't have to have all these people, but lo and behold, I do. And so I think AI will create the next generation of now. The question will be, can the current accountants make the jump to a new a new experience? That'll be an interesting thing to watch.
I'd love to give you both a scenario, get your kind of thoughts and ideas on a scenario with a company. And it always ties back to profitability, since that's obviously our topic today. But let's look at a business that is heavily reliant on some sort of debt vehicle. Perhaps their accounts receivable just don't quite come in as quickly as they'd like to convert that into cash. And they're having to rely on whether it's a line of credit or some sort of debt structure, if you will, to facilitate. But they're seeing, a path to additional growth. Rocky, maybe start with you. Would love to see kind of what your thoughts are on a business like that as you apply your model to it.
So we actually, in a situation like that, I go back to the beginning. Like, why are you offering AR? If you're going to be a bank, are we appropriately charging for that? Or are you a constrained business? Now, if you're a constrained business, how do we turn a constrained business into an unconstrained business? How do we get out of the red ocean and into the blue ocean? So a lot of that is the thinking strategy up front and coming up with the right policies, procedures, and proactive AR management. So, if, let's say it's a larger company, you bring on a new client, as soon as the bill goes out, or even before the bill goes out, a phone call. How is everything going? Everything wonderful? Great. Bill goes out. Phone call. Is the bill in the correct format for your systems to pay us? Did it arrive at the right place? What approval processes do you need? What can I do to help you to get all of that done so that we can get paid on time? And so it's that constant touch point in understanding it, and even teaching your salespeople, we're not paying you till they pay us. Right. So again, it's all of these different things so that everyone is of the mentality the sale is not done till the cash is in the bank, and we all need to make sure the cash gets in the bank so our paycheck gets paid.
Yeah. I think I agree with you on that, Rocky, that I think one of the keys is to go back and ask yourself, why do I have to carry this high AR balance? And if I'm going to carry it, there may be legitimate reasons for it. Then I need to make sure that I'm getting the benefit of that, that I'm charging for that, because it's something. And I think a lot of companies, especially companies where their sole criteria might be net income, for example. Well, you can make net income and not be dependent upon cash. And one of the things that I kind of like to see in the internal accounting is some kind of a cost of money charge. You know what? If you're going to be I'm going to make that as you do that deal, if you're telling me I can do this deal, but it's 90-day terms, that's great. But I'm going to charge 2% cost of money every month that's there. And that has the effect of causing the people to care. I'd rather figure out a way to shorten those terms. We have a client right now that we instituted that, where they were making profitable deals, but their deals involved, kind of lengthy pay cycles or receivable cycles, and they weren't taking that into account. So it looked profitable, and they were generating the gross profit they wanted, but they were, we're likewise having cash issues. And so the way to solve that, we said every deal you're going to incorporate for every 30 days that dollar is outstanding, 2% off the gross profit. And lo and behold, it became a focus. And half the bottle, people always say that you respect what you inspect, right? And so you put a focus on things, and then people start to operate to it.
And I think, it just reminded me of a story. I was just listening to a finance book, and they were talking about Ford. And it was a Ford warehouse. They had all these parts. And the manager goes to them and says, look, we've got all these parts. Why? Let me discount them and get them out. And they're like, no, you'll ruin our gross profit. And he's like, yeah, I might ruin your gross profit for the quarter, but you're A, going to have a whole ton of cash coming in, and B, we're going to have an empty warehouse that we no longer have to pay rent on and space, and we can actually bring stuff in. All of these things are interconnected, and I think you have to understand how those connections go together, and you've got to teach your employees. The reality is most employees are not financially savvy, and we're not rewarding them to make the company profitable. More often than not, you're rewarding them to spend money, right? You go, oh, nobody ever got blamed for buying IBM. Well, IBM was the most expensive. It's teaching your people to be financially savvy and to look at the entire picture. And at the end of the day, where's the cash?
Amen.
Well, gentlemen, this has been a riveting topic in finance, which is sometimes hard to come by. But I found it insightful, and I'm sure our audience will as well. I think, Rocky, we'll definitely have to have you on for another episode, because I feel like we could go on for a few more hours here if we pivoted to another topic. But with that, I want to thank you for your time, both you and John, for joining us today on the episode.
Hey, nice to speak with you, Rocky, and Matt. Thanks for having us both. I enjoyed it.
Thanks for having me on. Appreciate it.